Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jay Hatfield joins us. He's the CEO, founder, and portfolio manager at Infrastructure Capital Advisors. Jay, what did you make, or what are you making? How are you thinking about your outlook? We've got a Republican in the White House, a Republican Senate, and likely a Republican House. How does that inform your outlook for markets?
Thanks, Paul. It's great to be on. Well, we're much more focused on the corporate tax rate than almost anyone else, either politicians or investors. And the reason for that is that it's really the key driver of growth, not for just the companies, but also for the country as a whole. And you can do the math very simply by applying a pro forma corporate tax rate to earnings and then giving some credit for higher growth, because growth is driven by reinvested earnings. So if there's more earnings, you grow faster. So we are coming up with our 7,500 target. It's 23 times consensus earnings. So you can get on the terminal, that's where we get it, and then adjusted for the new tax rate. And so it sounds perhaps a bit nutty at 7,500, but a lot of people thought our 6,000 target for the S&P was nutty this year, which doesn't look very nutty right now. Maybe too conservative, but not nutty. And so we actually have superior target technology and have been quite accurate, at least during the pandemic.
So Jay, you're talking that you're basically calling the market out here. You're saying their fear of rising inflation is somewhat irrational. And I just want to kind of, for our audience, put some numbers out there. One year inflation swaps. That's what, the market is projecting average inflation to be in 1 year's time. It's up 22 basis points to 2.7%. You've got, the U.S. 1 year inflation swap alone at 2.5%, 5.4% last. I mean, talk to us a little bit about your expectations for inflation under a Trump regime.
Well, we think investors look at way too many data points to predict inflation. If you look at 10 data points to predict inflation and only 2 matter, then you're going to be wrong 80% of the time. So we look at just 2 things. And if you use this since World War II, you would have been the perfect inflation forecaster: money supply and oil prices, both of which are negative for the last year. And it's also important not to confuse.
So disinflationary.
We're at risk of a disinflation right now in our model. In fact, if you adjust the current CPI for shelter, which is miscalculated, and auto insurance and repair, which is pandemic distorted, we would have zero inflation. So we're much more bullish about inflation in the market. We think that'll be reflected slowly, not at this CPI. We're projecting an inline CPI at 0.3, but as it unfolds, we think it'll undershoot. We also think that the bond market's ahead of itself. We're going to have rebalancing. So we're projecting, and in fact, implicit in our target is more like a 3.50 to 4% Treasury. So if we're wrong about Treasuries, then our target will be wrong.
Yeah, I think for me, the real risk to that is obviously if something blows up in the Middle East, right? Because if you're right and it's money supply and it's energy prices, oil prices specifically, I think, that's the one kind of thing that might derail your 7,500, target on the S&P.
Absolutely, Damien. And that's a great point, because I think everybody's obsessing about the, deporting criminals as being inflationary, which I've looked at my Wharton textbooks and I never found that criminals were anti-deflationary, or the import taxes. But I will give you a case that the Trump policy is inflationary. And that is, it's not discussed so far, but I don't know if you noticed that in the Wall Street Journal, they said that Trump had been targeted for assassination by the Iranians. Well, there's a reason for that. He's going to reimpose oil export restrictions, which is inflationary. So that's the inflationary case. I would look at that. But keep in mind that oil is extremely weak right now. It's partly seasonal. So it's not clear that wouldn't really be effective and drive prices up, but I would watch that, and that is a real concern.
A 23 multiple. That's not what I learned in business school. I don't know where you went to business school, but my business, 23 times earnings?
Well, there's two factors. One I already mentioned, which if we're wrong about the bond market, we're wrong about the multiple. But the other thing that is not in those numbers, so I would say the risk, just like our 6,000 target is to the upside, is there's a ton of dynamic effects that are not reflected there. So if the U.S. goes to a 15% stated corporate tax rate, we're going to be a tax haven. Think of all the capital. It's going to be like Ireland that grows at 6%. Like we're going to have, phony shell companies with employees here. So there's a lot of dynamic deregulations not in our number. There's a lot of positive. When you have a pro-business administration and Congress, there's a lot of dynamic factors that can't get captured. So we think that even 23 and also AI, during AI booms, you typically have overshoot on valuation. So we don't think 23 is crazy by any means.
Well, Paul, remember, Jay may have gone to Wharton, but he was really educated at the school of Steve Allen Cohen at SAC Capital back in the day. And Steve likes to pay $700 billion for baseball players who formerly played for the New York Yankees or may still again be playing for the New York Yankees. I mean, Jay, talk to us a little bit about, some of the things you're seeing here. The dollar is rallying. I mean, copper prices are down. Iron ore is down. Any read through from that?
Well, there continues to be concern about China growth. They're a key consumer of commodities. We're actually more bullish than most about China. They do save 45% of their GDP, which the IMF estimates every 10% is 1.5% of growth. They don't get that because they're wasted on communist projects, but over time they will have pretty strong growth. So we're actually bullish on commodities. We do think oil prices will come off these lows. But I think that a lot of the weakness you're seeing there is, as you indicated, the dollar, but also some concerns about China.
Small caps? Can we play those here?
We like small caps. We have a small cap fund, SCAP. What a lot of people miss about that is you're really, mostly they are cheap, but you're getting a consolidation play. But also you're getting non-tech exposure. So small caps are only 10% tech. So you're getting a lot of financials. We love financials, particularly investment banks. We're carrying earnings estimates 30% above consensus for Goldman Sachs, but there's a lot of small investment banks in the small cap index. So it's a way to bet on kind of the non-tech sectors in the market.
All right, very good. Great stuff. As always, Jay Hatfield, he's the CEO. He's the founder, portfolio manager, infrastructure at Capital Advisors.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Heidi Crebo-Rediker joins us. She's the Adjunct Senior Fellow on the Council for Foreign Relations. She joins us. Heidi, when you woke up Wednesday morning, I've been asking this question for a lot of market investors. How did maybe the election change their investment outlook? Maybe I'll ask it to you in this context. How did it change perhaps the way you feel the U.S. will conduct foreign policy over the next 4 years?
So I think we're in for some pretty significant changes in many areas of the world. We have a very complicated backdrop of conflicts both in the Middle East, obviously in Europe with Russia, Ukraine, and then this ongoing competition with China and potential for real disruption in the South China Sea, and the question of Taiwan comes up, obviously. So I think there are. We just heard that Marco Rubio is the likely nominee for Secretary of State. He is not an isolationist, and he is one of the leading China hawks. So I think directionally, that's going to be very important. He certainly knows the State Department, and he has very strong views, very pro-Israel. So I think we're starting to see what that direction of a Trump administration foreign policy is going to look like.
Well, Heidi, you took the words right out of my mouth there. I mean, that's exactly what I want to ask you. We know everybody's a China hawk here, but my question is, where does Marco Rubio, Mike Waltz, and Elise Stefanik stand on other places like Israel, for example, and Ukraine?
So I think you have very strong supporters of Israel. I think that's without question, with Elise Stefanik, with Marco Rubio, and with Waltz. But you also have concerns, very, very significant concerns about where the direction of the Ukraine-Russia conflict is going, and how this administration, incoming Trump administration, is going to is going to deal with first and foremost, incoming President Trump has said he was going to end the conflict before he actually gets into office. I'm not sure how that happens. It's a very complicated world out there. You now have China, Iran, Russia, and North Korea all working together in various ways to keep and to triumph in a number of those conflict areas that we just talked about. So it's far more complicated than it was when Trump was in office before.
Heidi, you mentioned the hermit state, and so we need to go there. I mean, North Korea has fallen under the radar amidst what's going on, more broadly speaking, in the Middle East, in Eastern Europe, and now we have North Korean troops on the ground in Ukraine. I mean, talk to us a little bit about what that means. Is that a form of escalation? Does the U.S., President-elect Trump need to respond to that?
So it is very concerning. I don't think that it's flown under the radar at all with the national security community, and there's limited visibility into what deals were done between Russia and North Korea to actually get them to send their troops into this conflict. And as you know, there are tens of thousands of both Russian and with the addition of North Korean troops actually on the front with combat ready. And Ukraine is one area where I think you probably will see a significant change with Trump and his new national security team, because they will focus mostly on Asia and on China. And we've all heard about the calls that Trump himself and his close team has had with President Putin. So I think there are a lot of big question marks out there, but the world is far more complicated. North Korea is a big risk that I think particularly given its proximity to Asian allies, that we really need to start watching very closely.
Heidi, the Middle East, another very difficult and fluid situation there. You mentioned that President Trump and Marco Rubio pro-Israel. How do you envision that playing out, U.S. policy there? Because it doesn't seem like Israel's been listening to the U.S. over the past 2 years.
So it's Netanyahu is obviously complicated and has a huge momentum behind him in actually bringing about a complete conquering of Iran's proxies in the region, including Hamas, Hezbollah, and I think and the Houthis in Yemen. And so this becomes, you have strong alignment with the incoming team to the Trump administration vis-a-vis Iran, and limiting, curtailing, and completely, cutting the legs out of Iran's ability to actually to be an strong active catalyst and a negative catalyst in the region.
Heidi, 30 seconds or less, really quick. What's your thoughts on what's going on in Germany here? The end of Olaf Scholz, Friedrich Merz. I mean, what role do you think the U.S. and President Trump is going to play in that election?
So, I mean, obviously what's happening in Germany is it's simultaneous with a massive change in power in the U.S. And I do think that how Europe views its ability to ramp up its defense and security when you have Trump coming in and really not a fan of Europe, B, not a fan of Germany, and not necessarily willing to continue to fund the operations in Ukraine. So Europe needs money, Germany needs money. Their business model is broken, amongst other things. But I do think this early election, the fact that you are likely to see Merz and some kind of a coalition with the Greens come about is very much worth paying attention to.
Heidi, thank you so much for your time. We always appreciate getting some of your thoughts. Heidi Crebo-Rediker, she's an Adjunct Senior Fellow at the Council on Foreign Relations.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Sri Kumar joins us. He's president of Sri Kumar Global Strategies. And Damien, you'll appreciate this.
Santa Monica.
He's been all over the place. But how about this? Drexel, Burnham, Lumber. That is just...
good old days.
We're talking serious Wall Street credit.
Kidder Peabody.
The kids don't know who those names are, but we do. Shri, thanks so much for joining us here. The world's changed in the last 7 days here. Shri, give us your 30,000-foot view on the fact that we're going to have a new Republican president, we're going to have a Republican Senate, and potentially even a Republican House of Representatives as well. How has that changed your view of these markets?
Paul, good to be with you and Damien. I think the change happened. We didn't know who was going to win last Tuesday, but now we have clear-cut victory, a complete sweep by the Republicans, and it looks like the House also will go their way. It is both good and bad. The good part about it is it gives you a clearer indication as to which economic policies the president-elect would like to follow in his administration. The uncertainty is how the markets will react. While the equities have gone up sharply, there is more of a doubt on the bond side, and you can see the yields going up, and the mortgage rate is likely to increase as well because of the expectation that the fiscal deficit is not going to be controlled with the measures that Donald Trump promised before the elections. That, I think, is the big risk. That, I think, is the big change, Paul, in terms of what has happened. And look at the dollar. The dollar has strengthened so much. And that is just the opposite of what Trump wanted. He has always said in his first administration, he likes a cheap dollar. He wants low interest rates. And both of them, I think, are at risk now with a stronger dollar and potentially higher interest rates in the United States.
So, Shri, let's game this out here. Beijing, are they going to depreciate the yuan relative to the dollar if these tariffs go through? I mean, that would be the playbook, right?
That would be the playbook, but they can try and do that, Damien, in terms of what that would achieve for them in terms of the trade side. But if indeed the Trump is going to go ahead with a 60% import tariff on Chinese products, any extent of depreciation of the renminbi yuan is not going to offset it. The big problem is that the tariffs are going to be more important than the exchange rate as far as China is concerned. From a Trump point of view, he has to look and see what a tariff increase would do to the United States. I am a firm believer that tariffs are bad. They will push up inflation rate. And as a student of history, I looked at the Smoot-Hawley tariff of June 1930. It was done by President Herbert Hoover with a very good intention. We wanted to protect American farmers. We wanted to protect American trade. Instead, it gave rise to retaliation by trade partners, and that in turn made the depression deeper and more widespread than before. So that's the risk I think Trump runs, and he needs to be very careful with the tariff moves.
Well, Shri, you mentioned 1930, and I'll, pull out my regime model and, quote Edgar Denny here and talk about the Roaring '20s. A lot of people are making comparisons to this environment and that which existed in the precursor to the Great Depression. Talk to us a little bit about that. Do you see any similarities there?
There is a similarity in the sense that before the 1929 crash came, we had the big run-up during the 1920s. And that was because of policies which were expansionary. The Federal Reserve had been set up in 1913. There was also an expectation that things were going very well. And you had a free capitalist run taking place in the 1920s. But just as you say that it's the darkest before dawn, it's also the brightest before night. And that's what you have to be concerned about, that as you had the roaring 20s, the 1930s were nothing compared with a decade earlier. And you want to prevent a repeat of that. And that's why it behooves us to study the 1920s history and to prevent that from being repeated in the 2020s.
Shri, what's kind of your leading, I guess, investment thought these days when you talk to your clients? Because a lot has changed in the last week. What's kind of the theme you're going with your clients these days?
I say two things. One, equities are very highly valued. I don't pick securities, Paul, but I say to investors, clients, be very careful what you pick, because you want to be sure that the security characteristics are good enough for you to be very highly invested in equities. That's one. Second, on the fixed income side, I say to them that you have a situation when bond yields could increase and you could have a loss. And if that's the case, you want to reduce the duration of your fixed income presence, whether you are in US Treasuries, high-grade corporate bonds, or you are in municipal bonds. You want to reduce it. So that's the second one. And if you want to add a third, I would say the 60-40 traditional portfolio is no longer holds, and you want to have more alternatives, global real estate, other areas to reduce the amount of risk in your total portfolio.
So, Sri, U.S. Treasury curves have flattened off the back of the move. Inflation and growth expectations as built into nominal U.S. Treasury yields have risen. Talk to us a little bit about your expectations regarding U.S. monetary policy and the Fed. I mean, what are your thoughts on December and as we look ahead into next year?
I am to make my bias very clear. I said the September 18th, the Fed should not have cut interest at all, let alone a 50 basis point cut. I did not want to reduce it. And I've written about it. And once that happened, I'm not at all surprised that long-dated yields have risen as a result of that. And then the Fed cut interest rates again last week. The expectation is that December there will be a cut unless later this week we find out the consumer price inflation is way out of control. Anything manageable, I think Powell and his colleagues are going to cut rates again in December. And that in turn would be welcomed by the president-elect as something positive. The negative is going to come for Fed policy, I believe, in 2025. And I am assuming that Powell will continue to remain in office until May 2026. There will not be a danger to his position. He's going to lead the Fed. And if that's the case, 2026, he has to deal with the fact that with inflationary expectations up, because he has put so much of cash into consumer pockets, that he has to deal with higher long-term yields and how he is going to monetary policy. Cuts in rates may come to an end or even necessitate an increase in interest rates during 2025.
Shri, just finally, we've seen a big move higher in the U.S. dollar. How much farther do you think that has to go?
The US dollar could go up a lot further depending on Trump policies. Let me give you an example. If he does go through with the campaign promise of a 10% tariff on all countries and a 60% tariff on 60% tariff on China, expect the dollar to strengthen massively. For example, we are below $1.07 this week, the lowest since June. I can see the dollar going below parity, meaning less than $1 to buy €1 if you are going to be imposing a tariff on all the countries. That's how serious it is. And if Trump wants a weak dollar as well as tariffs, he cannot have both of them. He has to choose.
Very good. Shri, thank you so much for joining us there. Always appreciate getting a few minutes of your time. Sri Kumar, he is the president of Sri Kumar Global Strategies out there in Los Angeles.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Your daily look at the front pages around the world. Lisa Mateo newspapers. What do you got for us?
All right, so you've talked about it, Paul, how people can easily cancel their subscriptions to streaming services. You go online, you do a little click, and it's done. So now the Wall Street Journal is calling this like the new streaming habit. It's the subscription pause. So people are canceling and then coming back. And maybe if, because they had a show that ended, so then they cancel it and then they wait for the next season to start and they come back and do it. So it's really showing how streaming services really need to deliver these hit shows, films, live events. It's showing this is why the pressure is on for them to do this so they can keep getting those customers to come back. So quick numbers from Antenna. It says the monthly median percentage of premium streaming video subscribers who rejoined the same service they canceled within the prior year, 34.2% in the first 9 months of 2024, and that was up from 29.8% in 2022. So I don't know if you've done the whole pause situation.
This is I've been looking for. I'm a huge fan of Yellowstone.
Okay.
So I thought I could just go on Paramount, because Paramount does the Yellowstone. I go on to Paramount, it's not there. So I subscribe to it, then I unsubscribe to it 5 minutes later. And then I understand, I Google it, apparently it's on Peacock, so I go on to Peacock, subscribe. They're not there yet. They come later. I don't know how that all works. So then
wait, do you get hit every time you subscribe and then unsubscribe? Do you get hit with like a month?
I don't know.
We haven't figured that out yet.
Definitely.
So it is a terrible business model compared to what I brought into this world 30 years ago when we were banking all these media companies, and you just paid $100 a month and you got everything you needed.
That's right. That's right. The a la carte approach to some streaming media is definitely taking a bit of a hit here, but I think it's Netflix and everything else. Truthfully,
yes,
let's be clear. I mean, if you're subscribed to Netflix, you're not canceling that anytime soon. But everything else, I mean, Disney. I haven't seen anything new come out on Disney. Hulu. Hulu's different. I mean, Peacock. You're right. Max. It's hit or miss.
Yeah, it's hit or miss. So I don't know. I mean, I know you control your household with an iron fist.
I do. I've canceled out a lot of. I'm not the return. I just cancel.
Right.
I don't come back.
Exactly. So then, like, Mom, what happened? I thought we were. If your soldier's out there and you're canceling on him. Yeah. You can't get. Oh, that's not good.
Yep. Sorry.
Nice.
Hey, he has the YouTube subscription, and he doesn't give me his password. Okay. So I'm playing fair game here.
All right. Very good. What else you got?
Moving on. Losing your luggage. It's a big pain in the neck. I don't know if it's ever happened to you, but USA Today says this new Apple feature will let you tell the airline exactly where it is. So it's in the latest iOS update. They're expanding the functions of the Find My feature. I don't know if you use it. I use it to track my kids.
Use it all the time.
I track my kids on it. But they're saying that it's expanding it, so now you can share locations with other people, but also third-party vendors. So, for example, if you're traveling and you lose your luggage, you can share that location if you have an AirTag on it with the airline.
Where do you get you get an AirTag, right?
An AirTag, yes.
Okay.
I have like 20 AirTags in my house.
You do?
I put AirTags in every piece of luggage every time we travel. I actually look when I'm in the plane to make sure that the bags, which are still at the terminal on the plane, I mean, you have to. How do you not? I mean, this has happened to me many times, by the way, where I've lost my luggage. So, I'm scarred for it.
I haven't checked a bag of luggage in 30 years.
Yeah, I mean, I'll throw it on. I'll throw it on my daughter's shoelace just on the way to school to see where she's going. I mean, I do it. I use those AirTags.
Pop it in your wife's bag. That's okay, secret. I see how
you said that. I didn't say that.
But it does. It could be helpful. It could be helpful. Okay, so Chipotle shareholders. This is because of the skimping on the portion sizes. Remember that whole fiasco that happened? Okay, so shareholders now suing the company because they're saying the stock was affected because they weren't so open about how many places this was affecting. So they're saying it forced them to spend more on ingredients, hurt the stock price. So they're saying they realized the claims because people began complaining on social media, posting about the skimping on the portion sizes. So according to the complaint, I mean, this is what's happening. So I don't know.
All right, I'm a Chipotle guy.
Yes,
and
me too.
What's today? What's today?
Tuesday.
All right, tomorrow's my Chipotle day. I used to get 3 beef hard tacos with chicken.
Okay.
And then they got crazy and started overfilling them because of the social media backlash. I think the word came down. We're getting a lot of grief for underfilling our tacos and whatever. Overfill them now. So now I only get 2 versus 3.
Where's the beef? You remember that? Where's the beef? I mean, are we there again? I mean, this is Wendy's "Where's the beef" moment all over again.
I tell you, it's Chipotle's a good stuff.
I always thought that they overfilled it because you get the bowl and it's like weighs like 10 pounds. But okay. But yeah, so now there's a lawsuit in the works. So they got a lot going on.
Shareholders are
lastly, I don't know if you ever tried the 23andMe, like those DNA testing things. So if you ever have, the company's been struggling, right? So now it's saying it's laying off 40% of its workforce, more than 200 people. Restructuring, they said, would save the company $35 million annually. And it's coming from its drug development arm. That's what they're going to be closing down. But the CEO has been looking to take the company private. And it's been unprofitable. People take the DNA test once, and that's all they kind of really need to do. Have you tried it, Damien?
I've not tried it. Me neither. This isn't where it tells you what your lineage
your ancestry.
is. Yes, it is. Okay, my
yes.
wife did it. I don't want to give you the results. I was a little bit shocked. I thought I was marrying somebody completely different than who she really was. But look, I trust 23andMe, and their results are probably, I'm sure that's not the issue. Oh, I don't know. I'm a trusting kind of guy. Look, let's go back to the fact. I'm just getting a note in here from some of our listeners. There's a few other, things out there that are perfect, right? I mean, you could talk about, college sports. You could talk about Oregon, Indiana, BYU, Army. Yep. They're all perfect. But the interesting story here, Fordham Water Polo. Now 28-0. Wow.
Yes.
Fordham Water Polo. That is
In
perfection.
there, yes.
I'm sorry, I just had to deviate there. It's really, really important. One of my listeners is a big Fordham Water Polo fan.
But you think it should be California, right? Isn't California like the king of like water polo? But Fordham?
Not anymore. Welcome to New York City.
Fordham Rams. All right, that is our newspaper segment for today with Lisa Mateo.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.